I declare bankruptcy!
Hey guys, Breezy CPA here, your certified AI public accountant. Before we get into the video, make sure to hit the like button. Do it now. You know you're going to like the video. And if you want to see more videos like this in the future, please subscribe. If you're interested in learning more about accounting, taxes, or becoming a CPA, make sure to visit us at breezycpa.com to check out our library of courses. For a limited time, use promo code BREEZY20 to get 20% off your order. Link in the description box below. Now on to our video. So bankruptcy is when an individual, a C Corp, an S Corp, a partnership, an LLC, whatever it may be, is insolvent, which means that you can't pay your debts on time. You don't have to have zero money, you just have to not be paying your debts on time to your creditors. So that's what bankruptcy is. So there's two different types of filings for bankruptcy. You have a voluntary filing and an involuntary filing, when you're forced into it and when you voluntarily file for bankruptcy. So let's take a look at both of these. So in a voluntary filing for bankruptcy, you, the debtor, we're going to be assuming that you are the debtor in all these examples. So you as an individual are going bankrupt, your C Corp is going bankrupt, your S Corp is going bankrupt, your LLC is going bankrupt. So you as a debtor must file a petition with the U.S. Bankruptcy Court if you're going to voluntarily file for bankruptcy. A debtor files a schedule of assets, liabilities, income, and expenses. So you have to list out a schedule of all of your assets, all of your liabilities, all of your income, and all of your expenses to the bankruptcy court. In chapters 7 and 13, a trustee will be appointed by the court that marshals your assets. So they're going to be in charge of all your assets. In chapter 11, there's no trustee. This is actually important. Remember, for chapters 7 and 13, there is a trustee. For chapter 11, there is no trustee because it's a reorganization, which we'll get into in a little bit. So we also have involuntary filing, which is when you're forced into filing for bankruptcy by the creditors. So the people you owe money to, the creditors, are forcing you into bankruptcy. You're not voluntarily filing, they're forcing you to file. So this applies to chapter 7 and chapter 11. The creditors must be able to prove that they are not being paid on time, also known as insolvency. So if you as the debtor are insolvent, you're not being paid on time, the creditors have to prove that you're not paying them on time in order for them to qualify for this involuntary filing. Or that within the past 120 days, the debtor assigned a custodian to the secured property. So whatever property you owned from that debtor, if you personally assigned someone to sell those assets to satisfy your debts, and they can show that you did that within the past 120 days, then they can also use that to file an involuntary filing. So we have a couple limitations that you need to know for involuntary filing. So in order for these debtors to qualify for this involuntary filing, they need to meet these restrictions right here. And these are important. They have showed up on the exam before, so make sure you know these. So if you have 12 or more unsecured creditors, an unsecured creditor is somebody who provided a service for the company, maybe a cleaning service or window washing service or something like that. So you didn't use any of that debtor's money to purchase an asset for the company. So they don't have any stake in any of the assets for your company. They just provided a service for the company. So they're unsecured in the debt that you owe them. So if you have 12 or more unsecured creditors, then at least 3 of those unsecured creditors must file, and the claims must be in excess of $15,325. If, on the other hand, you have less than 12 unsecured creditors, then only 1 of those unsecured creditors must file, and the claim must be in excess of $15,325. $325. So once there's been a filing, whether voluntary or involuntary, a judge will declare an automatic stay, which means that they're freezing all of your assets, your cash, your property, they're freezing it all in order to determine how much you own and how much you owe to the various creditors. There are two types of businesses that are not allowed to be entered into involuntary filings, so no matter how much they owe the creditors, they can't be forced into filing involuntarily, and that includes charities and farms. So once an automatic stay has been issued, the courts freeze all of your assets and they start to take an accounting of all of the assets that you own and all of the debts that you owe to your debtors. Any legal proceedings against the debtor, any legal proceedings against you are stayed or frozen automatically upon the filing of bankruptcy. So any foreclosures, evictions, lawsuits, these all stop until the court can figure out how much you have in assets and how much you owe to the creditors. If a debtor fails to keep good records or falsifies documents, then a stay will not become effective. An automatic stay does not stop the collection of student loans, income taxes for the past 3 years, alimony and child support, debts or judgments from drunk driving suits, pension obligations, SOX violations, illegal activities, and debts not listed in the bankruptcy filing. So there's a few exceptions here for what the stay will not stop from collecting. So the important ones are the alimony and the child support, the income taxes, and pension obligations and student loans. So make sure you remember a couple of these. The stay does not automatically stop all collections. There's a few exceptions that you need to remember here. So once the stay has become effective, the creditors can't collect any more money from you. So there's some creditors who are going to say, hey, wait a second, I need my money. So those creditors can file with the court for a relief from the automatic stay. If they are granted relief from the automatic stay, then they can proceed with collecting from you, the debtor. But until they're granted that relief, then they can't collect from you. Bankruptcy attorneys must file a statement showing their payment for bankruptcy services and making sure that the fees that they're charging you for the bankruptcy services that they're providing are reasonable. So now that there's been a filing, whether voluntary or involuntary, and an automatic stay has been issued, 20 to 40 days after the filing, there's a creditors meeting where you, the debtor, are examined under oath regarding your assets and liabilities that you're claiming. The creditors are invited to attend this meeting and they can ask you limited questions. So after the creditors meeting, each creditor needs to file a proof of claim stating the nature and the amount of the debt that is owed by you, the debtor. If the creditor fails to file this proof of claim, then it may jeopardize their ability to collect from you in the future. So now let's take a look at the different kinds of bankruptcy. We have a liquidation and we have a reorganization. Under a reorganization, you just come up with a plan to pay all of your creditors that works to your satisfaction and their satisfaction. So under a reorganization, you come up with a plan. Under a liquidation, there's no plan. This is a complete liquidation. You sell all of your assets and you pay the creditors whatever you can get for those assets. So let's take a look at each of these. So you can file for bankruptcy under 3 different chapters: Chapter 7, Chapter 13, and Chapter 11. Chapter 13 and Chapter 11 are a reorganization, so you come up with a plan with the creditors in order to pay them back. And under Chapter 7, this is a complete liquidation. So you sell all of your assets and you pay the creditors what you can. So under Chapter 7, you can enter into Chapter 7 voluntarily, so you can go file yourself, or you can be petitioned involuntarily. So all those creditors can get together if they meet that $15,325 limit. They get together and they force you into filing for Chapter 7 bankruptcy. Once that happens, a trustee is appointed, and a trustee is someone who oversees all of your assets during the bankruptcy process. A debtor gives up trying to pay debts, so you stop paying all your debts, and you turn over all of your non-exempt property over to the trustee. What's exempt property? Well, that would be machines or tools that you use in your business. I mean, they don't want to completely wipe you out. They know you still have to make a living. So they let you keep the machines or tools that you use in your business so that you still have something to work with. But everything else gets turned over to the trustee, and the trustee sells all of those assets in order to pay the creditors. The court can issue an order of discharge, so whatever's left over after they sell all the assets and pay the creditors, if there's any debt still left over, then the court can discharge those debts. There's a couple different businesses that are not allowed to file for Chapter 7 bankruptcy, and they include railroads, banks, insurance companies, and savings and loans. Under Chapter 13, this is a voluntary petition, so only you can enter into this. You can't be forced into Chapter 13. And you, the debtor, and the trustee work out a plan together without the involvement of the creditors to figure out how to pay them back. This is for individuals, and it's known as the wage earner's bankruptcy. And this gives individuals a reprieve from the creditors, so it stops them from collecting from you until you can figure out a plan to pay them back. It creates a payment plan for the debt, and involuntary petitions, remember, are not allowed under Chapter 13. Under Chapter 11, again, you can file voluntarily, or you can be petitioned to file involuntarily. There is no trustee under Chapter 11. So there's a trustee under Chapter 13, there's a trustee under Chapter 7, there's no trustee under Chapter 11. Chapter 11 is for corporations, partnerships, and LLCs, and you continue to operate under Chapter 11. So your business continues to operate, but you have to come up with a plan that the creditors vote on in order to pay them back. And at least 2/3 of each debt class of creditors, so 2/3 of the secured creditors and 2/3 of the unsecured creditors must consent to this reorganization plan. So under Chapter 7 and Chapter 13, we have a trustee that is appointed. A trustee represents the bankruptcy estate, and they can be elected by the creditors. So the creditors can say, hey, we want this person to be in charge of this bankruptcy, and that person to become the trustee. However, the court is the one who appoints the trustee. So the creditors can elect them, but the court is the one who ultimately decides whether or not to appoint that trustee. Now, since the trustee is responsible for the bankruptcy estate, they can sue on behalf of the estate. They can also be sued because they're responsible for that estate. They must be paid a reasonable amount for their services, and any prior associations with the debtor is not allowed. So they're not allowed to have had any prior associations with the debtor. So the trustee oversees the bankruptcy and watches out for things like contemporaneous exchanges. So a trustee cannot void a payment that was made to a creditor that's an even swap. So an even swap is a contemporaneous exchange, and it's for new value. So let's take a look at an example here. If a company orders inventory and pays for it in cash on arrival, so they get inventory valued at $500 and they pay cash of $500 for that inventory once it arrives, then 2 months later they declare bankruptcy, this cannot be voided. So this cannot be voided because it's an even swap. You paid $500 for $500 worth of inventory. So these types of contemporaneous exchanges are not voided. If you were to issue payment for a prior debt that existed, then that would be voidable because you're not getting anything new in exchange for the money that you're paying. So a trustee is also responsible for looking out for preferential creditor payments. What are these? Well, it's things like fraudulent transfers. So if you make a transfer within 2 years of filing for bankruptcy, for example, you as the debtor transfer some property to your friend Bill down the street who owns a business, and you say, hey Bill, hold on to this asset for me until this whole bankruptcy thing blows over, and then give it back to me after that. You still own that property. That's a fraudulent transfer, and Under the bankruptcy estate, that property would be included into the estate in order to sell it to pay off your creditors. A trustee can also void payments on any antecedent debt, that's any past debt that you owed, that occurs within 90 days of filing for bankruptcy. So if Bill gave you a loan and you paid him back within 90 days of filing for bankruptcy, then that could be taken into consideration, and Bill might have to give that money back to be included into the bankruptcy estate, because you also owed other creditors money, and that would be considered a type of preferential transfer. So anything that takes place within 90 days of filing for bankruptcy could potentially be voided as an antecedent debt payment. This is also known as a voidable preference, where you're basically picking and choosing who you want to pay back because you prefer to pay them rather than somebody else. You can't pick and choose. You have to pay everybody equally. So preferential transfers can be voided, which means that the person would have to give the money back to the bankruptcy estate, if made within 1 year of the bankruptcy, if the person is an insider. So if the person's an insider, which means a corporate officer, a director, a partner, or a relative, if they gave you some type of loan and you owed them money and you transferred money back to them in payment of that loan within 1 year of filing for bankruptcy, they may have to pay that money back into the bankruptcy estate. If a transfer was made within 3 months, 90 days of filing to a non-insider, then the same thing applies. They might have to pay back that money. So if a creditor receives a larger payment than the bankruptcy liquidation would have granted them, then that payment is potentially voidable. So under Chapter 11 and Chapter 13, we have a reorganization plan. And basically, the debtor tries to fully or partially satisfy the creditors by making payments or restructuring their finances to pay them back. So the plan must be approved by the court, and the creditors may object if they don't like the plan. The court designates an agent to salvage the assets, restructure debt, and make any structured payments to the creditors, or even offer stock in the company in exchange for the payment of their debt. So just to review, we have two types of creditors. We have the secured creditors and we have unsecured creditors. So secured creditors, you use the debt to buy assets like a car or a machine, and that creditor has a secured interest in that property because you use the money that they gave you to purchase that car or the machine. So they have a superior claim to any other types of creditors. They can take either the collateral or the cash proceeds from the sale of that asset in the bankruptcy estate. If the collateral doesn't satisfy the amount that's owed to the creditor, then the secured creditor just becomes a general unsecured creditor for the difference. So an unsecured creditor, remember, is anybody that provided a service to the company. So a secured creditor, you use that money to purchase an asset, a machine, or a car for the company. An unsecured creditor, they just provided a service for you and you owe them money for those services. So the order of priority for the payment of these creditors is first you pay your secured creditors, and then you pay your unsecured creditors. And among the unsecured creditors, the order of priority in payment is you first pay your court costs and your fees, any child support or alimony that you owe, any expenses that took place in the ordinary course of business during the bankruptcy proceedings, any wages that are owed to employees, retirement contributions for the last 6 months, any taxes that you owe. And remember, look, taxes here have a relatively low priority. I mean, you're paying your secured creditors, then you're paying the court costs, you're paying your child support and alimony, you're paying expenses in your business, you're paying the wages of your employees, and after all that, then you're paying your taxes. So just remember here that taxes don't have a very high priority in bankruptcy filings for payment. So taxes, and if a landlord files for Chapter 7 and the bankruptcy trustee is in charge of, let's say, an apartment building that the debtor owns, then the creditors could be assigned the leases under the contract to the creditors in order to pay back any debts that are owed. So under Chapter 13 and Chapter 11, in order to finalize the bankruptcy, you make sure that the plan is completed, the creditors are paid what you could have paid in accordance to the plan, and you close the case. Under Chapter 7, there's a final discharge of debt, so the court issues a order of discharge. And for example, if the creditor owed $30,000, the trustee was able to sell assets for $3,000, then the creditor is paid 10% of what they were owed. The remaining balance is discharged. The creditor can sue and try to collect more, but basically the debt is discharged and the case is closed under Chapter 7. Under Chapter 7, 13, you get a fresh start. Some cases under Chapter 11, an individual debtor is no longer saddled with whatever debt they owed, but up to 10 years after the bankruptcy, it's going to show up on their credit report. So don't file for bankruptcy. It's going to be on your credit report for up to 10 years. That's it for bankruptcy. Thanks for watching. I'll see you in the next lesson. If you found this video helpful, please make sure to give it a thumbs up and subscribe for more content. If you're interested in learning more about accounting, taxes, or becoming a CPA, visit us at breezycpa.com for courses. Thanks for watching, and I'll see you guys in the next one.